I need you to do something right now. Open your brokerage app. Check the silver spot price. See it? 73.14 TOS. You glance at gold at $4,370 and assume everything's normal. But let me tell you, the number on your screen is a lie. It's a digital mirage, a ghost of a market that no longer exists. Because while you're staring at $73 in New York, in Tokyo, silver is being sold on the street for around $130. In the UAE, it's $115. In China, the physical price has already passed $110. We're not talking about minor fluctuations, we're talking about a staggering $50 gap between paper prices in the West and actual physical silver in Asia. This isn't a spread, it's a fracture, and that fracture is shaking the global financial system. Today, Friday, January the 2nd, we start a deep investigation into the global silver fracture. We won't speculate, we won't make guesses. We're examining verified data pouring in from Tokyo's resale markets, Japan's Ginza bullion dealers, and platforms like Mercari. Standard 1-ounce silver coins are selling for roughly 19,111 yen, roughly $130 at today's exchange rate. Why such a premium? It's not simply a love for silver. Japan's yen is collapsing. Debt to GDP exceeds 260%. The Bank of Japan has lost control of bonds. Everyday citizens are witnessing their savings evaporate and are fleeing to hard assets. When thousands of Japanese salarymen line up to buy silver, the local price disconnects entirely from New York's paper market. For them, $130 isn't expensive. It's insurance against the currency crisis. This fear premium is $50 over the U.S. spot price. Japan is only 6 months ahead of the U.S. in the timeline of financial collapse. And it's not just Japan. Even here in the U.S., the illusion persists. Spot silver reads 73.14, but go to a major dealer like APMEX. 100-ounce bars are listed over $40. That's nearly a 10% premium above spot. Coins are 20% higher. The real price of physical silver is already above the paper number. This is the first clue of a three-tiered market. Paper fantasy at $73, U.S. physical reality at $80, and Asian panic at $130. The deeper you go east, the higher the price. This is a broken arbitrage. Money and metal should flow to close these gaps, but they aren't. And this is where the wealth transfer of a lifetime is happening. Before we move on, hit like, share this video, and subscribe. If you think $73 is normal, watch closely. The Tokyo shock is the future coming straight to your screen. Now let's zoom back to the United States. You think the market is calm here? Spot silver reads 73.14, but the reality is very different. Walk into a major dealer like APMEX and a 100-ounce bar isn't $73 anymore. It's over $80. That's a $7 premium on industrial-size bars, nearly a 10% markup. Coins like American Eagles? Even higher, sometimes 20% above the paper price. The takeaway? The $73 spot is an illusion. You cannot buy real metal for that number. Even the biggest U.S. dealers can't source silver that cheaply. What we see here is a three-tiered market. Tier 1, the paper fantasy at $73. Tier 2, U.S. physical reality at $80. Tier 3, Asian panic at $130. The further east you go, the higher the price climbs. Arbitrage, buy low, sell high, is supposed to close these gaps. But it isn't happening. Why? Because the market is broken, trapped between paper contracts and scarce physical metal. Look at Tokyo, $130, Dubai, $115, Seoul, $97, China, $80. Meanwhile, New York still flashes 73s. Anyone paying attention can see what's happening. The U.S. is the cheapest market on earth. Smart traders are buying paper contracts, standing for delivery, and shipping the metal to high-priced Asian markets. This is Gresham's law on steroids. Bad paper driving out good physical silver. The question is obvious. Why aren't the prices converging? Why isn't New York catching up to Tokyo? Part of the answer lies in the physical supply chain. Secure transport is maxed out. There aren't enough cargo planes, armored trucks, or vaults to move silver fast enough. And insurance costs are skyrocketing because geopolitical tensions make shipping risky. The friction is real, and it's what's keeping the gap open. This is more than a market inefficiency. It's a global wealth transfer in motion. If you're holding paper silver or unallocated accounts, you're in the blast zone. But if you hold allocated physical metal, you're positioned to capture the next wave. Before we dive deeper in part 3, take a moment. Like this video, share it with anyone who thinks $73 is the real price, and subscribe so you don't miss the next update. The story isn't over. What's coming next will expose why the banks are trapped and why the paper market is a hostage situation. Now it's time to get inside the walls of the banks. Why are U.S. silver prices still stuck at $73 when Tokyo is paying $130? The answer is insolvency. The major bullion banks are sitting on short positions so massive that if the price of silver rose to its real value, they would literally collapse. This isn't theory, it's math. For decades, bullion banks have acted as market makers. They sell paper contracts for silver they don't physically own, betting they can cover the position later. Normally, hedging works, but in recent years, demand exploded and the banks overextended. They sold more paper than they could ever deliver. Naked shorts dominate their books. According to filings, the notional value of these derivatives is in the billions of dollars. At $20 silver, the exposure is manageable. At $70, it's painful. At $130, it's catastrophic. A rough calculation, 500 million ounces short $60 spike, that's a $30 billion loss. That wipes out earnings, hits Tier 1 capital, and triggers regulatory seizure. These banks aren't manipulating the market for profit, they're fighting for survival. Every contract they flood the market with is a desperate attempt to defend a solvency ceiling. The moment silver breaches $80–90, their balance sheets would implode. Every paper contract they sell to suppress the price increases their exposure. They are digging the hole deeper to prevent total collapse. This is the reverse of 1980, when the Hunt brothers tried to corner the market. Now, the banks have cornered themselves. They cannot buy without bankrupting themselves, and they cannot stop selling without facing delivery defaults. The result? A paper market hostage situation. Physical silver is fleeing the West, and the banks are powerless. Gresham's law is alive. Paper silver drives out real metal. Smart investors buy paper, claim delivery, and ship the bars to Asia. Meanwhile, the bank's suppression strategy accelerates the drain. Registered inventories at COMEX have dropped 70% since 2020. When the vault's empty, the paper price becomes irrelevant. The true price will be determined where silver is actually bought and sold in Tokyo, Dubai, Shanghai.
Before we move to part 4 and examine the broken arbitrage, hit like if this is the first time you're seeing the real market, comment your thoughts, and subscribe. The next part will reveal why the price gap persists despite obvious opportunity, and why the Western market may never catch up until the physical metal runs dry. Now let's talk about why the gap between paper silver in New York and physical silver in Asia hasn't closed yet. Economics textbooks promise instant arbitrage, buy low, sell high, and the market corrects itself. Reality is far messier. Silver is heavy, bulky, and expensive to move. To transfer $1 billion of silver, you need a fleet of armored trucks and cargo planes. And right now, every available vehicle is booked months in advance. Suppose you're a hedge fund manager in London. You see silver at $74 on the LBMA and $80 in Shanghai. You call a logistics company. I need 10 tons shipped tomorrow. The reply? Tomorrow. We're full until February. The physical pipeline is maxed. There simply isn't enough capacity to move silver fast enough. This friction is what keeps the arbitrage gap open. Insurance adds another layer. To ship bullion, you need coverage from firms like Lloyd's of London, usually cheap. Today, skyrocketing geopolitical tensions, drone attacks in the Red Sea, South China Sea disputes, restricted airspace over Eastern Europe, have made insurance premiums soar. The cost of risk is now baked into the physical price in Asia, widening the gap even further. Vaults are also bottlenecks. If you hold unallocated silver at a bank or bullion dealer and request delivery, they now tell clients 2 weeks minimum. Why? Because in a fractional reserve system, the metal isn't always on the shelf. It may be leased, stored in subcustodian vaults, or exist only as a digital ledger entry. Locating it, moving it, and allocating it to you takes time, delays that keep the arbitrage window open. Once the metal finally moves, the snap-up is violent. Picture a stretched rubber band, New York stuck at $73, Asia pulling at $110, $130. When the tension breaks, the Western price snaps upward in a single session. China and Tokyo don't drop. New York rises. That's the event we're waiting for, the reunification of paper and physical markets. Before part 5, take action. Like this video if your mind is blown, share it with anyone who thinks the paper market is normal, and subscribe. In the next chapter, we'll reveal the endgame strategy, how to position yourself to capture the gains when the snap-up happens, and why mining stocks are your best leverage in this global silver fracture.
Now we reach the final chapter. We've traced silver from Tokyo at $130, Dubai at $115, Shanghai at $80, and New York still stuck at $73. The global market is fractured. For the first time in modern financial history, a major commodity has two prices, an Eastern physical price and a Western paper illusion. The question is obvious. How do you position yourself for the inevitable snap-up? First, mining stocks. If silver in Tokyo is $130, but your local miners trade as if silver is $30, $73, there's a massive valuation gap. These stocks are selling real-world metal at discount prices dictated by the paper market. When the snap-up hits New York, their earnings won't just double. They could triple or quadruple. This is leverage, torque, and opportunity all wrapped into one. High-quality primary silver miners right now are a coiled spring waiting to explode. Second, physical versus unallocated silver. If you hold unallocated silver, an account or a pooled certificate at a bank or dealer, you are extremely vulnerable. When the U.S. price finally adjusts, banks may choose cash settlement at the old paper price, not delivery. You will see a cash balance on your account, but that cash will buy less silver than the market demands. The lesson? You must hold allocated physical metal, bars or coins under your name, or in a fully segregated vault. Pay the fabrication fee, pay for shipping, and control your asset. Third, mindset. $100 silver price will change global psychology. $73 feels expensive today. $100 validates the metal as real money. Tech companies, pension funds, and sovereign wealth will flood the market. FOMO will push prices toward $200 faster than anyone expects. You must be ready to hold through this mania. Selling early means leaving generational wealth on the table. The verdict? The U.S. paper market is hemorrhaging real metal. Arbitrage is broken, vaults are draining, and Western investors are at a crossroads. The global fracture is your opportunity. You were early, you were prepared, and now you know the mechanics of the system. Take action. Like this video, share it with anyone holding paper silver, and subscribe so you don't miss updates. Position yourself in mining stocks, secure physical metal, and be ready for the snapback. The fracture is here, and it's creating the next wave of wealth.